You've heard of Harshad Mehta, right? But do you know the man who quietly picked up the threads from where he left and rewrote the history of the Indian stock market in the early 2000s? This wasn't a scam built on chaos. It was built on precision. 40,000 crore rupees moved across accounts, stocks pumped sky high, and the system watched silently. This is the story of Ketan Parekh, the mastermind who made the stock market dance violently before being caught in his antics. The rise of Ketan Parekh. Ketan Parekh wasn't always the infamous name in the world of stock market. He started as a chartered accountant and then joined Harshad Mehta's Gromo firm in the early 90s, learning the tricks of market manipulation firsthand. In the late 90s, he began to dominate Dalal Street, leveraging his understanding of stock market psychology and turning it into a game of greed. What was his strategy? Manipulating stock prices with the help of institutional investors. How he pulled it off, Parekh's strategy was simple yet deadly: pump and dump. He focused on the information, communication, and entertainment sector. At the time, the dot-com boom was on, and stocks in tech, media, and telecom were all the rage. Parekh zeroed in on a few companies and made K10 stocks. He inflated stock prices through circular trading, where brokers repeatedly bought and sold the same stock to artificially raise trading volume. He manipulated institutional investors to jump in, using his connections and massive promotional schemes. The result? Millions of retail investors poured their savings into his infamously known K10 stocks, believing they will reap huge profits in little time. Prices of K10 stocks like Pentamedia Graphics soared from 175 to 2,700 rupees in this period, proving his manipulation did work for a little while. The fall, when the bubble burst, payouts stopped. Stock prices collapsed. Investors were left devastated. And the banking system? Ketan Parekh had been borrowing massively, raising funds from banks like Madhapura Mercantile Cooperative Bank, Global Trust Bank, under highly questionable circumstances. The exposure came when Bank of India revealed that Parekh had defrauded them of 137 crore rupees using bogus pay orders. The government was forced to intervene. Within days, Ketan Parekh went into hiding, but it was too late. The damage was done. What went wrong? How did this fraud go unnoticed for so long? Weak regulations allowed Parekh to manipulate the market without much oversight. Unregulated borrowing from cooperative banks that weren't subject to the same checks and balances. And perhaps most crucially, a lack of investor awareness in the late 90s and early 2000s. Aftermath and current scenario post-scam, the SEBI and CBI came down hard on Ketan Parekh and his associates. However, the damage didn't stop there. The stock market collapsed under the weight of the scandal. Investors lost crores of rupees. Parekh himself was banned from trading until 2017, arrested and convicted of insider trading and price manipulation. Even as late as 2021, Ketan Parekh was still facing legal consequences. The damage caused by his actions was not easily undone. The hard lessons. What can we learn from the Ketan Parekh scam? Beware of too good to be true returns. If something promises you massive profits without risk, it's a red flag. Always verify the legitimacy of financial schemes. Make sure they're SEBI registered and regulated by authorities. Educate yourself about market basics and how stocks, bonds, and investments actually work.